Hello everyone, and thank you for joining us. Today we will be giving an overview of the 2008 financial crisis as well as the 1997 Asian financial crisis, and taking it a step further by comparing the two events. We will then delve into what could be done to avoid a similar crisis moving forward. So, what exactly is the financial crisis? Well, the global financial crisis, which came to light during the summer of 2007, was namely a result of the low interest rate environment from 2001 to 2004 in order to pull the US out of the short-lived recession it faced in 2001. The government slashed the federal funds rate over 10 times, lowering it from 6.5 to 1.75%. This low interest rate environment, in turn, resulted in a sharp increase in market liquidity. This highly liquid market acted as a breeding ground for subprime borrowers who were then able to take out loans at very attractive rates. Regulations determining qualified applicants were so relaxed that even individuals with no income, no jobs, no assets were even able to take out loans. As the number of individuals eligible for home loans increased, the number of houses purchased increased, and thus the prices of houses increased. As a result of the easy credit situation, coupled with the increasing housing prices, high interest yielding subprime mortgages were seen to be especially attractive investments. This led to the creation of mortgage-backed securities. Since rating agencies claimed that many of these mortgage-backed securities were safe investments, individuals and firms invested heavily in these assets. The understanding at the time was that even if some people defaulted on their loans, the rest of the mortgage-backed security still has value. That said, once interest rates started rising, many people couldn't afford to pay down their debt or even make the monthly interest rate payments, and in turn defaulted. As an increasing number of borrowers began defaulting, investor demand for these mortgage-backed securities diminished essentially overnight, and the value of these assets plummeted. So essentially, the crux of the issue lies in the fact that these assets were too complex and no one really understood the true value of them.
The Asian financial crisis was a major economic and financial crisis in East Asia in 1997-1998 that affected particularly Thailand, Indonesia and South Korea, but also the Philippines, Hong Kong, Malaysia and Singapore. It was actually a private debt crisis that led to massive depreciations of Asian currencies and an economic downturn. Asia has liberalized its financial market in the 1990s and attracted, having a relatively high interest rate, huge amounts of short-term capital from foreign investors that was invested in domestic real estate and in the stock market. This credit boom and sharply increasing asset prices in the housing market led to the emergence of a bubble in a system that was highly leveraged. Banks and financial institutions were often subject to lax capital requirements, and supervision of banking was often not regulated sufficiently. Risk wasn't managed effectively since they relied on their national governments to bail them out in case of financial troubles. Exchange rate risk seemed negligible because many Asian currencies were pegged to the US dollar, and furthermore only little foreign reserves were held. Foreign investors believed in risk sharing and were willing to invest largely in the Asian financial market. In the course of speculative attacks on the baht, the private debt crisis was triggered in Thailand. After revelation of unsound debt, large capital flight and credit downgrading were induced, leading to the end of a fixed exchange rate system in Asia and massive depreciations of Asian currencies. It became apparent that long-term loans granted domestically in local Asian currencies and existing foreign reserves were not enough to repay short-term debt denominated in foreign currencies. When bankruptcy occurred, real estate prices and stock prices declined significantly, causing the bubble to burst. As a consequence, the Indonesian rupiah and many other Asian currencies depreciated between 40 and 80% within 1 year. The GDP and number of exports decreased significantly, leading to global recession, rising unemployment and poverty in Asia. The most severe affected countries were granted loans of a total of $40 billion by the IMF through structural adjustment packages that were conditioned on structural reforms, particularly in the financial sector, in order to stabilize the banking system. These macroeconomic measures taken managed to stabilize Asian currencies to a large extent in 1998, bringing the Asian currency slowly but surely back on track.
After this short explanation of both crises, we will now draw a comparison between them. Our first point of comparison, we analyze why a bubble was formed. Firstly, in both cases, financial institutions lacked incentives for good risk management. One reason for this was insufficient regulations. In Southeast Asia, ties between the government and the economy strengthened this phenomenon. There were risk-sharing guarantees, and in some cases, investors could not use business criteria to allocate credit because they had to fulfill certain policy objectives. Also, foreign investors did not manage their risk properly because they believed that Asian governments would bail out troubled banks. Eventually, financial institutions took on excessive risk and became highly leveraged. Secondly, information asymmetry was a major cause. Investors systematically underestimated the risk of their assets. In both cases, financial markets were opaque. In the US, this was due to the emergence of the shadow banking system, while in Asia it was due to nepotism. Thirdly, the prevailing interest rate in both cases led to the bubble. In the US, the very low interest rate encouraged borrowers to borrow excessively. However, in Asia, the opposite was the case. The interest rate was very high, and so borrowers borrowed abroad. Therefore, they took on high levels of foreign debt, which contributed to the bubble. So we can see that there are many similarities. However, there is one major difference. The financial crisis of 2008 was caused by the US insular effort, while foreign investors played a significant role in the Asia financial crisis. Their herd behavior drove up the demand, which in turn drove up stock and real estate prices in Asia well above the fundamentals, causing a bubble. Our second point of comparison are the reasons why the bubble actually burst. One side of the story is basically the same. The delinquency rate of the underlying assets started to increase. In reaction, investors withdrew their money and the bubble burst. However, in the Asia financial crisis, there is one key factor that we cannot find in the crisis of 2008. These are speculative attacks on currencies such as the Thai baht. The collapse of the Thai baht marks the definitive burst of the bubble.
Thirdly, we compare the mechanisms influencing both crises to have such an impact. The burst of both bubbles turned the initial euphoria that prevailed while the bubble formed into pure panic. Most investors started to transfer their money out of the assets that seemed so promising before and turned out to be toxic now. However, the run on the financial sector that emerged during the crisis did not reflect a pure reevaluation of the underlying. The investors expected a free fall in asset prices, and as everyone did withdraw their money, the drop in prices became a self-fulfilling prophecy. However, the problems in the underlying and some steps of the vicious circle displayed large differences in both crises. In the global financial crisis, the run on the financial system happened in financial products, when people tried to get their money out of the SIVs and CODs, which held lots of mortgage-backed derivatives. In the Asian financial crisis, we observed less of a run on specific financial products, but rather a run on the whole currencies. The investors tried to withdraw all their investments in the region, as the devaluation made assets denominated in these currencies worthless for the foreign-based investors. To conclude our comparison, we analyzed the consequences. As both crises started in geographically and politically different circumstances, they also display major differences. The reason of the global financial crisis were merely domestic, as American banks and companies were the issuers of subprime mortgages and mortgage-based securities. Yet the American stock market played such an important role in the world economy that the consequences were global. Contrary-wise, the Asian financial crisis was fueled by foreign investors and hot money inflows that drove up prices. The speculation was predominantly by foreign-based companies, but the consequences were limited to Asian countries, Russia, and to a smaller extent Brazil. In both crises, the IMF issued large economic stimulus packages to mitigate the effects of the crisis. Even though these packages had some impact on limiting the economic recession, they were widely criticized by not tackling the root of the problem, namely the unregulated herd behavior and risk underestimation of speculative investors. The IMF measures were also insufficient to lead to a quick economic revival. The global financial crisis in America especially drove up unemployment rate over an extended period. While this was a minor issue in Asia because of labor market, there is less downward rigidity. Instead, the Asian financial crisis brought real equity and estate prices down, caused a recession with negative GDP growth up to 17% and free fall in currency depreciation.
In retrospect, signs and warnings of an emerging financial crisis can be easily identified and could have been avoided by implementing possible preventative measures. A possible solution to prevent a large economic bubble from bursting could be achieved by preventing an uncontrollable bubble from forming in the first place. This could be done through government-implemented limits that restrict the level of debt individual business entities, including domestic banks, can take. This prevents the formation of a highly leveraged financial system, which was a main contributing factor for both crises. Having strict capital requirements protects depositors and promotes the stability and efficiency of a financial system, thus lowering risks of insolvency. Even in the case of insolvency, a reasonable amount of losses will be absorbed, reducing depositor losses. Of course, there is the issue of whether a government can set an acceptable limit without causing inefficiency. A restriction too harsh would adversely affect business prospects because of reduced investments, yet a restriction too lax would simply be useless. There is also the issue of whether governments have the right in the free market to restrict business and individuals from making decisions regarding how much debt they take on. Secondly, we propose capital controls, similar to China's implementations, preventing hot money inflows by restricting the amount of domestic currency in the global market, as well as preventing sudden money outflows leaving the economy once the crisis begins. In effect, capital controls would have helped to alleviate the issues faced in the Asian financial crisis, when the huge outflow of capital and the sudden shortage of foreign investments worsened the financial situation. As capital controls restrict both the inflow and the outflow of capital, it also prevents speculative attacks from materializing. There is also the role of the IMF to evaluate the aftermath of the East Asian financial crisis. Whilst the IMF did provide bailouts to minimize bank runs and liquidity problems, could austerity measures imposed by the IMF have prolonged the effects of the crisis? Restricting the level of business confidence and investor spending by using contractionary fiscal policies like higher tax rates adversely affects GDP growth, and therefore has significant implications on economy's recovery. Not to mention the lower consumer and business confidence in the domestic economy, which further deter investments that are crucial for economic recovery. There is also the issue of opening up financial sectors, a bailout requirement demanded by the IMF, which benefits the foreign investors who played a part in causing the actual crisis. In hindsight, perhaps allowing countries to freely decide their own recovery problems without tough restrictions on the domestic economy may actually be better for a better recovery result.
Furthermore, reducing the level of information asymmetry is a way to prevent a crisis from occurring. Information asymmetry was a key problem in both crises. By regulating and ensuring that relevant and accurate information is transparent and known to all investors, a crisis can be prevented because it gives investors the chance to manage their downside risk more effectively and take more preemptive measures. For example, the US government could enact laws to enforce that mortgage loans are only granted to people that meet minimum standards, and it could try to discourage the increasing complexity of financial instruments through regulations. In the case of the Asian financial crisis, ties between the government and the economy should be avoided to make the system more transparent. Moreover, credit agencies' misconduct cannot be understated, as they had led investors to mindlessly buy into the high-risk mortgage-backed securities. Their role in evaluating securities should be questioned, and their responsibilities in evaluating securities could be transferred to impartial government agencies to prevent the herd behavior born from these credit agencies' evaluations. In conclusion, is it likely that such a crisis will happen again? Looking back at the crises, the IMF and the domestic countries' efforts in battling falling investment and output had some positive effects. However, whilst government regulations were implemented to prevent similar occurrences from happening in the future, the policies have ultimately been very minimal in effect, or almost non-existent. Future crises, therefore, are inevitable because of the ever-changing nature of the financial industry. The recent American credit crisis is a good example. In addition, business entities will always try to achieve personal gain without consideration of the externalities involved. Past experiences have given us greater insight on how to fix a crisis' effects. but not a clear, effective outline to prevent one from happening. And so, as of now, the cleaning up process is ultimately all we can really do.